So a couple of, a little bit more detail on China. We've just had the GDP numbers, and the top left sort of shows you where they are. The composition, which is down the bottom, it's mainly domestic growth in China. A lot of people say, oh, you know, it's a bit of a bubble, etc., etc. And when Europe falls over, then China will fall over. That's actually not true. Generally, the focus in China has been we're going to try and get rid of excess credit. So we're going to try and crunch down on, in particular, in essentially the trusts and the non-bank lending, and we're going to make sure the housing sector is under control. So what they're trying to do is avoid a problem before it really gets going. Just to give you some numbers, top left there is basically Chinese credit to GDP. It's around, it's something called a leverage ratio, but basically the long run average across the world is around about 400% if you look at total credit against the GDP. Australia's about 300, China is about 200. So the Chinese credit numbers are not exceptional. The problem you have in it is that you're not really sure in China about what's actually happening. If you look down the bottom on the red circles, depending on how you count it, public sector debt in China, I've circled there 3 numbers. Total public sector debt is 50% of GDP, 53%. They have 2 bits. They have essentially central government debt, and then they have local government debt where you're not supposed to have any. But what actually happens is that local governments set up essentially a trust, which then goes off and borrows. And that's outside the banking system. And so in total, public sector debt is around 50%. Global average, around about 90%. Australia, by the way, is about 17%. So we can come to talking about do we have debt problems later. But generally what you can see in the official data says the Chinese debt is not actually that high. Now, there's a lot of things in state-owned enterprises that we just don't know. And so you're never really sure about that. But the idea that you sometimes read in the newspaper that Chinese has this debt bubble is actually not true, statistically anyway. And this is just a chart in terms of trying to break it up. What I've tried to do here is put the blue lines, which is showing you the change, and there's been a big change in bank bills recently, which no one really understands yet, so that's the next one we're worried about. But what I was really trying to look at is if you look at the banking credit, which is essentially the second line there, that's essentially up a little bit, and the trust and entrust loans, so that's essentially the non-banking stuff. And they've come down quite a lot, so they're down about 20%. So the key thing I'm trying to pick out here is the Chinese have tried to cramp down on the non-bank lenders, and it's successful, or has been successful. If you look at the various bits and pieces of where the Chinese economy is, in the top left, the dark line is industrial production, and we've put that up against some surveys. They're coming down, but if you look at the axis on the left-hand side there, industrial production is currently running at around about 9%. If anything, it looks like it's stabilised a bit. There has been quite a slowdown down the bottom in real estate, and manufacturing was also a bit softer. So what you're seeing is they have cracked down on credit. They're very hard into trying to make sure you don't go over the top in terms of housing. And that's also had a sort of a flow-on effect in Australia, in Canada, etc. If you're cracking down on property and the Chinese still want property, then they're increasingly looking to the Australian market, to the London market, anywhere that they can have for good quality property, and particularly apartments, because apartments essentially are new, or new apartments, because if you go to a new construction, the Chinese or anybody else don't have to go to Foreign Investment Review Board. And one of the big drivers of what's been happening in the property market recently is, in fact, this crackdown on the Chinese side. If you look at some of the other data, investment in real estate sort of slowed to zero. Export data is very spiky. If anything, what you've had is a bit of a slowdown in export values, but not the sort of crunch you had back in 2008, 2009. The other thing is, you know, Chinese get their data out really early, and there's a lot of sort of dodgy stuff in there, and so you have to be a bit careful. And I'll give you an example. So if you look down the bottom there, there's a bit of volatility in the export data, and if you break it up the top in the red, the export data to East Asia about 12 months ago went up at 60%, and now it's sort of down at -20. What is that? Well, what it actually is the Chinese getting money out of the country illegally. Because what you do is you have an operation in the mainland and you export it to Hong Kong, and then you put it on a truck and take it back, or you actually just pay for the export, get the money out, and then you can do whatever you like with it. Chinese authorities caught up with it, and so the 60% didn't happen, and the -20 didn't happen in a fundamental sense. So you do need to look at the data underneath it and say, what's going on? And unfortunately, when the markets see something like Chinese exports down 20%, they say sell. And then it's up 30% and they say buy. Really, it's just volatile data. The last thing I'd say down the bottom there is, if you look at the consumer real retail sales, they're still growing along at about 10% per annum. So there's a lot of local dynamics in China. It is slowing. It is the second biggest economy in the world. You can't grow it forever at 10%. Our forecasts basically have it growing at about 7.25% this year and something like 7% next year. At 7% growth, China generates as much demand for commodities as what it was previously doing when it was growing at 10%. And the other thing I put in red there is if China grows at 7%, it takes them 2 and a bit years to create a new South Korea. All right? So this is not falling over anytime soon. And it's very important in terms of where Australia's trade relates to China, particularly because in things like iron ore, that's essentially, we send a lot of iron ore there and they pay us a price. In very simple terms, forget about bankers and lawyers' margins. The big Australian iron ore producers ship it into China, land it at about 45 to 50 bucks a tonne, and today they're uptight because they're selling it at $95 a tonne. Used to sell it at $180 a tonne. But basically my story about China is it's not a bubble, they're slowing it deliberately, and basically I expect it to continue to grow at those sort of rates for quite a while.